We need oil stocks to move up. Boy, has it been a mess for oil so far this year. Let's take a look at the sectors. 4-1 advancing to declining stocks at the open. Nice open, another new high for the S&P 500. Finally, energy is leading. We've been talking about what a mess it's been for the last several weeks. Materials also up. But as you saw, rates down a little bit this morning. Utilities have come to the fore. Banks have been underperforming as well this morning. Hope you all saw Becky's great interview with Steve Mnuchin, the Treasury Secretary. Made a rather extraordinary claim, I thought. He said the stock market rally was a report card on the Trump administration's performance, saying it's a mark-to-market business. Live by the stock market, die by the stock market. But certainly there have been two factors powering the rally, and we have discussed them extensively here on CNBC. Number one certainly is the Trump trade, tax cuts, infrastructure spending, and regulation reduction. But there is a second factor, almost equally powerful, called the reflation trade. This involved higher rates and a synchronous improvement in global economies. This existed long before the Trump electoral victory in November. In fact, this started in the summer of last year. This has also been going on and also adding fuel to the rally overall. What we're seeing today, of course, is a continuation of the trends that we've been seeing in the stock market. People have been worried about whether or not the market's going too far, too fast. We're not seeing any signs of deterioration. New highs every day, keeps broadening out. Today, big names, United Technologies, Apple, JP Morgan, Cisco, all new highs. The advanced decline line, the cumulative market, stocks up versus down every day, keeps hitting new highs. Credit conditions remain favorable. There's no immediate signs of any technical breakdown in the market. There has been problems in a specific sector. We have talked about it for a week and a half, and that is in the oil sector here. We have seen the S&P Energy Group down almost 4% for the year, while the S&P 500 is up almost 6%. That's a 10 percentage point divergence. That is very unusual for a major sector, and you can't blame it on oil. Oil has been fairly steady for most of the year, right now up about 1%. We've talked about the problems with Exxon. Yesterday, Exxon was not far from a 52-week low here. It's been down 10% for the year. There's a one-year chart for it. You see it's up a little bit today as oil is on the upside. The problem is very simple. Analysts are expecting earnings to go up about 75% for Exxon this year, but much of it predicted on oil getting into the 60s. The market is starting to doubt that might happen here. Look what happened this morning. They're writing down almost 15% of their oil reserves from the books. Some of it is Canadian oil sands. It would be too expensive to extract that at the current prices. That's a very big write-down, about 15%. The number two problem is, remember, they are the largest natural gas producer in North America. You know what's been going on with with natural gas below $3. Warmer weather, that happened yesterday. That's a problem. And finally, we have the fracking production increases. A lot of discussion about that may very well limit the moves in oil towards getting towards $60, where a lot of these companies need to be to get the earnings up to where they're expected for 2017. Morningstar just had a comment out about this. I think they echo a lot of sentiment on the street. This is Morningstar. Major increases in shale activity now have U.S. production firmly on a path of rapid growth. This growth, plus the eventual supply increases from OPEC, is likely more than enough to erase any market tightness and throw crude markets back into oversupply. And I think that is the primary overhang on ExxonMobil as well as the rest of the oil section. Although today, remember, all the oil stocks are trading to the upside. 4-1 advancing to declining stocks. Dow's up 30 points. S&P, another historic high. Guys, back to you.